Kevin Green, senior markets correspondent, right away to help set up the action today. All right, so we continue to have those gains happening, especially in the NASDAQ, but also the S&P 500 hitting a record. But it was not all systems go because small caps were actually left out yesterday. So tell us about how you view the makeup of how we're seeing markets now.
Well, if you're just looking at it mathematically, Diane, I mean, the sectors that you really want to see outperform are doing their job. Communication services and technology continue to lead the way, and those are two of the biggest weights for the S&P 500. Now, we'll talk about Oracle here in a little bit, but overall, the price action, once again, continues to move to the upside here, kind of bucking the trend that we've seen usually in September, where it's a little bit difficult when it comes to the markets here. And I think we're just really trying to figure out what the Fed's going to do next. Now, yesterday, if you kind of look at the 10-year yields, we saw a little bit of a re-rating back to the upside. When you're looking at the yield space, that probably put a little bit of pressure when it comes to the small caps. But overall, once again, we are in a market where we continue to try to find narratives. We have a new narrative right now when it comes to Oracle, and that might be able to kind of dampen the blow if we do get a hot inflationary print, either PPI, which is going to come out today, and or CPI tomorrow. So I think that's kind of the landscape right now, looking at those tech names, trying to see a little bit of a rotation within those tech names as well, going away from the hardware space, going away from the infrastructure build stocks that saw a significant bid over the last couple of years, the fabrication makers, the ASMLs of the world, and things of that nature, going from that to NVIDIA, and now seeing a transition over to the cloud players and the data center or the data management players like the MongoDBs, the Oracles of the world. And that rotation probably is enough to get some dollars off of the sidelines and really try to kind of prop this market up, at least for now. There's some cracks under the hood here, but we're not seeing it when it comes to the price action. The bull trend, if you're looking at the technicals, still remains intact right now.
So let's talk Oracle. Coming into the show, I said it's up more than 20%. Right now, it's up 31% in the pre-market. You add that to the gains that it's had so far this year. That would mean a gain, if things stood where they are now, of about 75% for the year for Oracle. I don't know if anyone saw it coming. I mean, I saw analysts becoming more and more constructive, and you saw a price target hike after price target hike on Monday of this week, and you don't usually see that many. So it looks like the sell side was really watching this one. What stood out to you in terms of its latest results?
Yeah, well, given the fact that Oracle set a pretty high bar in the last earnings announcement when it came to the guidance, this earnings announcement obviously exceeded the street's expectations here. And it's really where they are seeing growth and what they are projecting out in the future here that really shocked the street. Now, if you're looking at the current quarter, revenue did come in at $14.93 billion. It did miss the street's expectations of around $15.04 billion. And the adjusted earnings per share did beat the street's expectations, or I'm sorry, missed the street's expectations, coming in at $1.47. Street was looking for $1.48, but it's all about the guidance moving forward. They're looking at the cloud infrastructure revenue for the quarter grew around 77% on a year-over-year basis, and they looked at the long-term trajectory, and they're looking at actually increasing or pretty much 10xing their cloud infrastructure growth in 5 years, which is remarkable to say the least. Now, we also have a line item called remaining performance obligations, a very key measure when it comes to Oracle as well as some of these other companies here. That's just the backlog of orders that you have, and then also the products or the services that you still have to deliver that you have not realized revenue on. And that is where we saw the massive jump when it came to demand. Their ARPU number came in at $455 billion. That's an increase of 359% on a year-over-year basis. That's before that number, it was 138 billion within their backlog. So you could see that there is very strong demand. Now, it's a select number of customers that are really fueling that demand. And what's interesting, Diane, is these major hyperscalers, say the Googles of the world or OpenAI, obviously they're building up their own data centers, but they really do see strong demand. And so now they're leveraging Oracle's capacity in order to service their own customers within their ecosystem. And that's something that's going to potentially pay off for them here in the long term. And that's where the market is really getting excited about. And that also kind of translates into the chip makers. If you're looking at the AMDs of the world or NVIDIAs, today they're catching a little bit of a bid, because if Oracle is going to continue to spend and build out their data centers, which they did represent or say that they are going to continue to ramp up their CapEx, that could be at least some demand for those customers as well. So that's really the story. It's not the fact that they're getting a bunch of enterprise customers, not the mid-sized or small-sized companies. It's the very select few that are trying to offload their existing demand in order to meet the customer's needs.
Yeah, and look, And then some analysts point to the deeply entrenched customer base that it has in general, and some of that conversion to the newer business and newer products there as a benefit for Oracle, plus the sovereign customers as well are within that group. So let's talk about a laggard today, Synopsys. Revenue falling short of estimates. What are some of your takeaways with its results really quickly, KG?
Yeah, so this is a company that provides software designs for chips here. We did see a miss both on the top and bottom line. Revenue coming in at $1.74 billion. Street was looking for $1.77 billion, and the adjusted earnings per share came in at $3.39. Street was looking for $3.74. They are seeing a drag when it comes to demand. They did miss a couple of deals, maybe lost a couple of customers as well, and they did mention that tariff policy is kind of hitting some of their end users of their product offering, and that's why you were seeing the shares down. Last time I checked, down around 20% or so. So this is a name, once again, that's still within the artificial intelligence space that did actually see some enthusiasm early on in this type of cycle, but now facing some headwinds as maybe the fab capacity itself, or maybe the chips that we have to the market right now and the designs that we have meet the needs of the street. And that just seems like the different, or the bifurcation that we are seeing within this economic cycle or this AI cycle right now. And that should continue over time. Now, the question is going to be not so much for Synopsys, but when do we start seeing the software players, the pure players, really catching a bid and really starting to see outperformance here? Maybe that's going to be the next earnings cycle that we have, the Adobes of the world and things of that nature. But right now, it seems like if you have capacity within your cloud or your data center, it seems like demand is there. But if you're a chip designer, you have the design software to build out these chips, it seems like demand's kind of waning at the moment.
Okay. And then, KG, let's talk about today. In focus, inflation, PPI. What's the expectation?
Yeah, so for inflation, you're looking at PPI, both headline as well as core, increasing by 0.3% on a month-over-month basis. Now, that's actually decelerating from what we saw last month, which really did shock the street. But this is a very volatile print, very hard for analysts to really pinpoint where that number is going to come in at. And we also have to look at two key items, Diane. One is going to be intermediate goods. So we look at the final demand goods portion as that PPI number that we report on, but intermediate goods are really the ones that are going to be impacted by tariffs. So keep your eye out on that, because that has been running a little bit hot. And the other area that you want to see if it does come in hot for PPI is it because of investment services fees and management fees. That actually has been a very big component as to the price increase. And usually we see those fees increasing as the market also melts up and doesn't provide that much of a concern as far as inflation. But if you start seeing it on the good side, the raw materials, the diesel, crude oil, things of that nature, that's where it becomes a little bit more of a concern. So given the fact that we have this Oracle number, and I'm not trying to minimize inflation, given the fact that we have this Oracle number, we might be able to sustain ourselves, at least for now, if communication services and technology, once again, kind of outperform today, because they're not really impacted by the inflationary environment like consumers like yourself or myself.
Okay, speaking of the melt up, what's your target on the S&P 500 to the upside and to the downside?
Yeah, for resistance to the upside, 65.55. To the downside, first area major support, 64.85.
All right. Thank you, KG. That's our Kevin Green, Senior Markets Correspondent. Appreciate it.